Welcome to Power Charting. I'm Bruce Fraser, your host. Today, we are going to talk about the interest rate story. Interest rates have been so interesting for a while now, and I think that interest rates are telling us a story. And it's a little bit like Lassie. Remember back in the 50s, probably nobody remembers, but back in the 50s, there was a show called Lassie. And Lassie was this beautiful dog, and Lassie had a buddy, Timmy, when they would go on adventures, and Timmy would fall down a mine shaft, or he would get stuck in a tree or something. Things would happen. And Lassie had to get Timmy out of trouble. So Lassie would go find help, and Lassie would bark and bark at whoever, trying to get them to understand that Timmy needed help. Well, I think the bond market is like that. The bond market is like Lassie, shows up, says there's trouble or something's going on, but it can't tell you exactly what it is. It just says, pay attention, try to figure this out, see if you can find Timmy and save him. So we're going to do a bit of a detective story here and see if we can figure out what the bond market has been trying to tell us lately. And I like to do all of this with stock prices and ETFs, and do the true, pure technical analysis and see if we can't sort out what the issues are. And it is kind of a detective story that way. So let's have a look at the agenda for today. And I have way too much to do way too many things for the time I have. We're going to talk about interest rates in the economy, primarily through treasury bonds. Then we are going to look at junk bonds because they tell a special and interesting story. And then finally, we're going to talk about one of my very favorite indicators for the stock market. I think you're going to find this interesting. And then finally, if we have time left, we're going to talk about the financial industry group, one or two of them, and the stocks in those groups. So let's start by going back to a chart that we looked at in a prior episode and on the written blog, and that is, in this case, the Dow Jones Industrials. This is a daily chart, and we have 2-point and figure counts that we've taken that were very interesting in the March through May time period. This blue box represents a count that was a beautiful count on an intraday basis that took us to 25,000, 24,800. And since that time, the Dow did in fact fall down to that area. And we had said that this was, we believe, because of this point figure count, likely to be a spring, and that it would attempt to, once it reached this level, rally back up into the trading range area, and we would watch and see how well it rallied. Well, it did in fact go down to, say, 24,750 area, and then it turned off of that and very sharply rallied back up into the trading range. Quite impressive. We had a larger count that we counted as distribution. We said at the time that this was quite speculative and that we would consider that once we saw how well this market rallied. Well, I think the rally's been pretty impressive. And so, and for that reason, and the reasons we're going to talk about today, is potentially bullish. So here's that point figure count across here. It goes down 25 to 24.8. I'll leave it to you to go make a chart that's current, that shows the rally subsequently, and you can bring that up to date. And also you could do these point and figure charts for practice, but they've been very helpful and useful to us. This in fact is a 60-minute chart and shows the base that was made back in December, January of 2018, 2019. Okay, so now let's get to our subject for today, which is the bond market. So this is 7 to 10-year US Treasury bonds, or notes, I think, as we would prefer to call them, in an ETF. And this is IEF is the symbol, 7 to 10-year Treasury bond ETF. And back in December, we said, early December, we said, hey, accumulation count is complete. We've jumped out by 1 box. We said at the time, there is a substantial cause built for a rally. The iShares 7 to 10-year Treasury bond ETF has generated a meaningful cause for a rally in bond prices, drop in yields, and has already jumped out of the accumulation area. This rally actually began in November. Here's the low right here. Well, we had 2 counts that we showed at the time, and that was with a final high area of 107.25. And let's get that's right here. And so subsequently, it rallied up to and through this level. And this happens all the time. I tend to always count point and figure conservatively, and then I will extend the counts later, which is what we're taught to do. And so we've taken 2 smaller counts, and here we had a count later on, which was a stretch count, which is this yellow box. And this is the entire base, which is entirely appropriate to count. But see, this doesn't hurt us because we can see the accumulation, and we can see that this is gearing up for an important jump up and out into a new uptrend. And then as the uptrend progresses, we can then extend our segments on our counts. And reaching a count in and of itself is not a reason to sell the instrument. It tells us that we want to then just assess and see whether the trend is still strong. Well, we had ultimately a count on the stretch count that went to 108.57. Well, the 7 to 10 year went to 109.42. And so here we can see on a vertical chart these counts. Here's the additional count up to 108.57. And here's the high so far. And notice this, that into this full count of the accumulation area, we have a rather dramatic climactic surge. And so this surge, and we have sort of a trend line here that we can draw, and we throw over the top of that trend line, overbought with the climax into a point and figure count trifecta. Fabulous. And so the other thing to note here is, look at how much interest rates have fallen. Now this is the 10-year Treasury here underneath, and this has fallen from just under 3.25 down to below 213. That's a huge decline in interest rates, which produced a massive rally in Treasury bonds. So why is that? Has that happened because the economy is slowing down? The economy's in trouble. So we need to do some detective work and see whether we can come to a conclusion about the state of the economy. Here is the 20-year US Treasury, which has a higher rate, is more volatile because it has a longer duration. And you can see here that this also has had a massive increase. It went from around 110 all the way up to above 132, around 132.5, about a 20% move in bond prices. That's a massive move in a short period of time on falling interest rates starting in October, November. And so these interest rates have gone from just under 3.4 down to under 2.4. And so again, very big decline in rates, which suggests that there's been some kind of important change in the markets here. And the question is there trouble in the US economy? Is there trouble in other parts of the world? And there's a flight to quality, and we talked about this last week with our gold and dollar discussion. So go back and review the written blog and also the video blog. But there appears to be some kind of a disturbance in the force here. So let's go and see whether or not through some additional detective work. Oh, here, let me just say this. Here is the same accumulation area in the 20-year Treasury bond, one box reversal, 1 point scaling, and it counts up to 128, 133. Well, we've just gotten there. So we're there now. And so this is a count that goes to this point here, and then we have a stretch count or a further count that goes to here, and a stretch count that goes to here. So we've counted the second count, 140, 135, but I suspect that, especially with fulfilling the entire count on the 7 to 10 year, that we are going to be range bound for some period of time, possibly building a new count for a further run up. We don't know, it's too early to tell, but we've had an important run and we've fulfilled a count, and we've also done that with the IEF. So but here's the cool thing about treasuries is that these falling interest rates, they're at a lower level now, and they're liable to stay at this lower level for some extended period of time. And so as long as they're bouncing around here and they don't start to, interest rate don't reverse and start to go up a lot, but just stay in a tight little range, that's still very supportive of the economy and very supportive of stock prices. And so this is a good thing if interest rates fall and then they stay at that lower level. They don't have to keep falling to be very helpful for financial assets. Here is just a picture of the S&P 500, and I want to just put forward an idea, and that is that here we've had a range-bound market for the past about 18 months. And so a lot of volatility, no price appreciation after a beautiful trending market prior to that. And so here we have a range-bound market. We've had a nice jump up and out of the range, but it came back in again. So far, it's only come back about a third, which is what we would look for as Wyckoffians, is a run up and then a 1/3 retracement approximately. And so we can see here that we've had that, and now a nice jump has occurred. And this jump is the jump that occurred after we hit our point and figure count, by the way, on the Dow Jones Industrials. And so this was the count being fulfilled, and now we're rallying back up again. Well, these interest rates that have been lowered over a period of time since November is a prop or a support for stock prices. And does this suggest that the stock market can now get up and out of this 18-month trading range and start a new uptrend? Now that would be very meaningful. And I'd also like to point out that the very high yields and low prices in bonds and the trouble that came in the markets, you can see that the markets just collapsed into a shakeout type move while interest rates were being raised by the Fed. So there's many who think the Fed had a overreach in their policy decisions, and the December rate increase that they had was an overreach. It was a policy error, and that the Fed noticed and identified that they'd made a policy error, and through open market operations started to help the bond market to rally. And so I believe that that absolutely could be the case here, and that this is the reason that we had a big rally in bonds, and we've also had a big rally in stocks in the first half of 2019. And we're setting up for a potential jump out of this big trading range. So interesting conditions, and I'd like to show you the junk bond market because it might support this view. Here is HYG. These are corporate bonds that are of below investment grade quality, also known as junk. Now, there's a lot of junk bonds out there. A lot of corporations have taken on debt to rebuy stock and reduce the float of the stock in their companies, and do other things too. And so a lot of corporations have lowered their credit quality through doing this and have actually fallen into junk status. Now, that could be a problem down the road. That's a big problem if the economy slows down. Not such a big problem if the economy is expanding. And so far, it appears the economy domestically has been expanding at about 3% and may continue to do so. So notice this. This is the end of 2018. Here's October through December in the junk bond market. Junk bonds are falling, and then they just collapse into the end of the year. Well, at the same time, ironically, you have the treasury bond market having a very good rally. So that and the treasury bonds started rallying in November. So they're moving in different directions. This is because corporate junk bonds tend to move with the economy because they're very sensitive to economic conditions. Junk bonds tend to be more correlated to stock prices than they are to interest rate moves. So when the economy slows down, it makes it harder for junk bond issuers to be able to pay interest and principal on these bonds because the economy is slowing, cash flow is diminishing, business conditions are worsening. So we like to look at junk bonds as a litmus test, a surrogate, the canary in the coal mine of there being either health in the overall economy or trouble. And so that decline into the end of December with a climactic surge showed that there was stress in the junk bond market. I have heard Fed watchers say that the junk bond market basically was closing down. They couldn't even issue bonds. So that was a real measure of stress in the financial market, stress in the economy, stress in stocks because of their tremendous amount of debt on their balance sheets. And so that created the collapse. And so the Fed started to lower Treasury interest rates in an attempt to try to resuscitate the junk bond market and the economy, which I believe was slowing into the end of the year. Well, look what happened to junk bonds. Look at this beautiful rally. They rallied right with the stock market. So whatever the underlying conditions that help stock prices, they were also helping corporate junk bonds, and they were rallying together. So always think of junk bonds as being correlated to stocks more than correlated to the treasury bond market, and use them together. So if you think there's a good rally coming in the stock market, oftentimes the junk bond market will rally with stocks, especially if the economy is good. And so I conclude from this, now look here, junk bonds have started to run up and out of the this trend again and are starting to make new highs. That this, we could conclude, means that there is good support for the economy now, and these lower interest rates are really helping the overall economy. But why is it? So this is really great that we're seeing this rising bond prices. This is the TLT, and falling interest rates. Well, what is the message here? There could be trouble in other countries, and that the U.S. Treasury bond market is benefiting from money flowing into the U.S. And so, and also this could be why gold is acting well. Look at my video blog from last week and my written blog on gold and the dollar, because it could very well be that there is stress. This could be because of tariffs and other things, that stress in other countries is causing business and investment to come to the U.S., which in and of itself may not be a great thing, because if the world economy keeps slowing down, eventually it's got to affect the U.S. But for now, this appears to be a positive development for the financial markets because the junk bonds continue to go to new highs. Another junk bond that you can look at is JNK, and it looks pretty much the same. It's the same story, but also that's another one to watch. I like to watch both of those as a surrogate or a measure of economic health. Okay, so let's go in the time that we have left. Let's talk about the stocks above their 200-day moving average, which is one of my all-time favorite indicators. I've been using this for years and years. I love it, and I want you to love it like I do. And so here is basically how to think about it. Here's two important bull market lows. Here, beginning of bull markets. Here and here, 03, 02, 03, 08, 09. And so you can see that these are important bear markets, and this indicator is quite low. And what it says is, this is the percentage of stocks that are above their 200-day moving average. And this, you can see in 03, it's about 10%. A very low 10% of stocks are above their 200-day moving average, long-term moving average, only 10%, very few stocks. When the new bull market started, this number jumped up and went up into the high 80s or low 90s. 90 went from under 10 to 90% in a very short order. And this is like a launch. It's a liftoff. And when that happens, it says that there's a new uptrend occurring, and it's going to go on for a long time. And that's exactly what happened here too. So we have these beautiful uptrends. They went on for a long time. This is the ringing of the bell that tells us to get to work and start to buy stocks and be with the trend and just stay with these good stocks that are above their 200-day and look for the trend to go and go and go. Now, there's another element or another quality to this indicator that's very important, and that is that it diverges at important highs and lows, but it's different. The lows are different from the divergences at the highs. So here you can see that we have two lows here. This one's slightly above this one. And notice this, lower lows on the S&P 500 here, and this is a divergent characteristic. And when you get that, it's a tiny little clue, but when you get that, you want to start to look for stocks that are already in bullish uptrends, that are leading the pack, leading the way upward. And you can see here, there's a higher low, much higher low here up at the 20-25% area, higher low here. When you get higher lows from the market, you get higher lows from this 200-day indicator, you're in a position where an uptrend is starting and the number of stocks is expanding, very bullish. So by the way, here's the indicator symbol, $NYA 200R. And this is the percent of stocks above the 200-day for the whole New York Stock Exchange. There's also another one for the S&P if you just want to look at the 500. There's also one for the 50-day. And so you can check those out. I tend to just focus on this, but I do look at the others. Here, look at this divergence. My gosh, in 08, 09, this number got below 5%. Oh, it was near zero. There's no stocks, very few stocks above their 200-day moving average. This is very bleak. But look, lower lows, higher lows here from a very low level, and look at how that set up the beginning of a very important uptrending move that went on for a long time. Now, here's the thing, that these indicators occur in the shorter term. Here you can see higher low here, lower low here. And so this is a deeply oversold market. Now, another thing, when you get into a good uptrend, I'm going through these quickly because I'm going to run out of time, is in a good uptrend, you're generally only going to get reactions that go down to about the 40% level, which is this pink line. You see lots of pullbacks and uptrends at the 40% level. When you get to that level, you want to start to look for trend following tools, moving averages, trend lines, relative strength lines that can help you to identify where to start to add to your existing positions. This is a place to add in a good, strong uptrend. And so divergent characteristics in important uptrends. Look at this one here in 2018. This is the 2018 peak right here. Look at how this indicator has been falling off the whole time. So generally you'll have divergences from high levels. These should not scare you out of the uptrend. But when you start to get divergent characteristics, look at the climactic surge in the S&P 500 into the beginning of 2018. And notice how this is making lower highs throughout. Well, this should be worrisome, and you get a correction off of this. This was actually a really good trade. And then you have another rally that occurs here that goes to a new high. This happens a lot. So you're at a new high here. Well, look at how poor this rally is. This rally doesn't even get to 65%. And so you have a very poor quality rally in the underlying breadth. And then after this upthrusting high is made, and you can see this is like X-ray vision. It tells you that there's trouble underneath the surface. There aren't a lot of stocks that are supporting this uptrend. And then look at the severity of the decline. There was so much price damage in this decline into this was into the end of 2018. So into the beginning of 2019, this was a severe, this is all, I think this also scared the Fed, was just the severity of the drop in the internal components, important stocks in the S&P 500, and how low, this got down to almost 10%. So this was a terrible decline and a V bottom. And now notice the rally. The rally so far has only gotten up to the mid 60%, 62.5% level, somewhere in there. So it's not lifting off into a really high level yet. We're going to need to see this jump out for the S&P and see this number just get higher and higher. Otherwise, we are having a compromised breadth situation on a long-term basis. And so this is very important. Other tips I would point out is notice here in this bear market move here, notice how the breadth deteriorates dramatically here while a top is being made. And so here is just a slightly lower high right here, and the breadth has fallen off dramatically. And so this is what you will tend to see in a top, as a top's being made, and that's exactly what we saw here. So we're not out of the woods now. Similar condition here as we saw back here, but it is a little stronger on the bounce than it was in 08. So this is something to study. Look for these tremendous deteriorating conditions, and you can see the opportunity to where to buy, where to sell. The other thing you can do is zoom in. So build this chart and then zoom into shorter time periods, and you can see here's a divergence here, lower low, and this is a equal low. And so that is a sign that the market is tired of going down. And on that, thanks for joining me. I'll see you next time, and we'll do this again.